And joining us now to discuss it is Wells Fargo CFO John Shrewsberry. He's also a member of the CNBC Global CFO Council. John, good to see you. Thanks for being with us this morning or this afternoon.
Great. Thanks. It's nice to be here. And as was described, we announced our earnings this morning. We had a great quarter by all measures. We had a lot of profitability, $6 billion worth of net income. We generated an ROE of north of 12%. We had a lot of signs of momentum in our business, big pickups in our originations of small business loans, of home equity loans, of auto loans. We've got big momentum in payments with our debit. We're the biggest debit card issuer in the U.S. We had almost 10% growth in payments in the quarter, and credit card payments up about 7%. So there's interesting things happening all over the company.
Yeah, what were you able to tell us and investors today about the outlook on a couple of stories, I guess, that people seem to be concerned with on the investment side? Obviously, the strength of the mortgage business, which has had a little bit of a drop-off, and then net interest margins at a time when perhaps banks are going to have to compete a little harder for deposits.
Sure. So on the first one, in terms of mortgages, with long rates a little bit higher, the refinancing business is much smaller for the industry than it was 50 basis points ago or even 25 basis points ago. And so that smaller market is much more purchase-oriented, and so those are the customers that everyone's pursuing. There's excess capacity in the industry because it was sized for the larger market that included all of those refinancing, so margins are a little bit tighter. And we anticipate that the overall size of the market will be a little bit smaller next year in the, call it $1.5 to $1.6 trillion versus the $1.6 to $1.7 trillion this year with thinner margins. So there's a reason. It's a reasonably big part of our business. It's about 15% of our non-interest income, both servicing and origination. We're happy to be a leader in it, and we love it for the long term. But there is some adjustment going on, and I think it'll have an impact on people who are smaller players. With respect to net interest margin,
go ahead.
Go ahead.
No, go ahead. I want to hear what you say about
margin, that. As rates move up, most banks, including Wells Fargo, are asset sensitive. We expect to earn more with higher rates because our assets price up faster than our liabilities. You know, the related questions, and you raised whether deposits are going to cost more. They likely will, but it's this cycle has been slow to adjust on the deposit pricing side versus where assets have priced to. So it's we've seen more in the last 6 or 9 months of people with excess liquidity moving out of bank deposits and into money market mutual funds and other cash equivalents. So there's some of that going on, but it's still better than history would have predicted in terms of what deposit costs mean for the first 200 or 225 basis points worth of movement by the Fed off of zero over the last couple of years. So that'll continue to express itself. We're all competing for deposits and for customers, but I like the chances of expanding net interest margins.
I was just going to ask how, John, your results as a whole tell the story of where you are in dealing with all of the scandals and the Fed restrictions on growth. Because on one hand, the surprise revenue was great to see on that front, but then, deposits leaving and loan balances declining. Does it show that you guys are still in the process of putting this behind you?
Yeah, sure. So I would say, revenue up, expenses are down. Both of those are good things. Expenses are down is a reflection of what you're referring to, because they're down year over year primarily on having settled different types of settlements over past issues, frankly, some of which date back to the financial crisis, not just sales practices related issues. So on the momentum front, I would say that things are actually really good. With respect to the asset cap and the overall growth of the business, we took a couple of measures right at the beginning of the year to create plenty of headroom so that for our everyday customer activity and lending and deposit taking, the asset cap isn't really impacting those customers or the business that they do with Wells Fargo. So that feels good too. We're getting a lot of things behind us. The momentum is good in the business. I described that there are certain categories of loan originations that are up double digits year over year, and that really reflects both engagement of our own team members and their interactions with customers in those areas, like home equity, like small business, like auto, among others. So,
and just before we go, John, just wondering if your take right now on the state of commercial loan demand, because I think that has been one area of perceived softness out there.
Yeah. So commercial loans are both business loans and commercial real estate loans in the way that we describe them. I'd say in commercial loans, demand is up. In fact, those balances are up on our books. There is more non-bank activity that tends to be a little bit more aggressive. There isn't a lot of incremental utilization of available commercial credit by our borrowers. Our borrowers tend to be cash rich. They're performing very well because the economy is doing as well as it is. And also the bond market is wide open. So there are people who are terming themselves out or borrowing incrementally in the bond market and not just on banks' books. So those things are all going on. With respect to commercial real estate, it's more frothy. There's a lot of non-bank activity. I mentioned on our call this morning that in 2016, banks accounted for about a third of commercial real estate funding, and in 2018, it's about 15%. So it's really a combination of asset managers, hedge funds, other non-bank players that are contributing to funding at a more aggressive point in the cycle, and that shows up in terms of weaker on-balance sheet fundings for banks. It's from a credit perspective, we're actually okay with that.
John, you guys have such a good window into the economy, into housing. How are you thinking about this big sell-off we've seen on Wall Street this week in the context of what's happening with the economy and interest rates?
Yeah, so the sell-off in the stock market seems completely detached from what's happening in the real economy. I mean, we're on fire right now in the high threes this year and probably into next year as the benefits from tax reform and still relatively low rates are being expressed. Our own call is for things to begin to slow down as a result of rate increases after the end of next year, but you don't see it in today's confidence numbers. You don't see it in the flows. I mentioned what's going on in terms of payments through the system that shows how busy the consumer. Well, in housing, it's regional, right? So it depends on what market you're talking about. Certain long rates have made refinancing less popular, but home prices, the borrowing costs are still, in generational terms, very affordable. What's happening in housing is a function of what's available for housing, what market people are in, how far they have to commute, what their preferences are for single-family home ownership versus living in an urban core and commute patterns. There's a lot that's going into it, but we're still talking about a $1.5+ trillion mortgage market in the coming year, which is a lot of origination.